Hello everybody and welcome to my mid-monthly market update. I am pretty excited actually because not only have I got lots of bang up-to-date information what I've been up to over the past couple of weeks, but quite a bit of research that I've been doing, particularly this past weekend from various market sources, which I want to talk you through. And I'm quite keen to get on with that side of things. So I hope everybody can hear me very clearly. And I know there's some questions. I'll try and answer those as well as we progress. So just kicking off then. These are the key topics I'm going to cover today. Key market overview, FX key outlook for the month, Spain, because that's on everybody's mind. What works and what's still keeping me awake at night. What Soros owns now, that's just one slide and I thought I'd put it in there for fun. And spread betting firms, I mentioned on this after well spreads, what does it mean for everybody either who is an account holder there, such as myself, and what does it mean in terms of getting our money back that might be held with them. So I'm going to give the information as I have it on that as well in this. So let me continue. I have got one person who says they can't see me. So as far as I can see, my screen is clear and people can see the screen. So I hope that's only a technical hitch with one person and that everybody else can see me. Yep, I've got screen is good from someone. Thank you very much for that. So let's kick off with what we've got coming up this webinar. The first thing I want to do, as I always do, is go through the warning notices. I have to do this because they are important. First of all, some of the products we might happen to mention in passing are things which are leveraged, like foreign exchange, like spread betting. Well, please be aware that these are leveraged. They can inflict high levels of risk on investors. I know you're all aware of these things, but I am obliged to mention it. Also, remember, this is not individual advice. I can't give individual advice because I don't know the individual concerned, and this is my own opinions and commentary and analysis on the markets, not individual financial advice, which again, I know you're all used to hearing these things, but it is the case and I do have to give that important notice to everybody. Finally, if there is anything on any of the products that I do own that I'm speaking of, I will give, of course, disclosure on that. But I should mention that should I be long cable, for instance, I don't think we're going to move the markets. But should there be any particularly illiquid securities, and I tend not to mention illiquid stocks, but were I to do so, then of course I'd give full disclosure were there any that I own. But as I say, I tend to avoid owning anything illiquid. And as I say, I don't think we're going to move the market on Apple stock anyway. But again, I just want to make that absolutely clear and put that out there. So let's get started. Where do I draw my information from, as well as my own analysis, of course, and my own experience? Well, for this mid-monthly review, the information source has come from several places, and these are just some of them. I get a daily briefing from Bloomberg, which tends to give me the most detailed analysis anywhere. And as I've mentioned in webinars before, the reason I particularly like this is I want to look at the things which the biggest banks are looking at and the biggest hedge funds and the people who are really going to move the markets are looking at. And it's obviously not enough just to look at the Financial Times. You've really got to look at detailed analysis from economists coming out of the World Bank and so on, and the IMF. And this is the kind of information I get from the Bloomberg daily briefs. It's not what's on their website, it's what's sent to their terminal users. And their terminal users include everybody from George Soros downwards. So I analyze those briefs every single day. That's one thing. The second thing, amongst other, is the banks. Now, there's a lot of banks that we're linked with. My own asset management company uses Edmund de Rothschild fund services for our fund, and therefore we do tend to get invited to lovely little things such as soirees in Bratislava. This one, actually, the invite just came in today, so I thought I'd ping it up on the webinar. I mentioned this because it also lets you know that I try to get access to information which is exclusive, and if anybody knows how the Rothschilds made their fortunes, then you will know that they made it from access to information which was exclusive. So we particularly like going to their events. Then of course there's the usual stuff. There's Goldman Sachs and their private bank, and this is just a little header mask that I've copied here of some of their research, and you've got other private banks, in this case ABN AMRO. I haven't put the Deutsche Bank one up there. That's another source of information. As I say, I like to get my hands on exclusive private information. I put all that into one of these webinars and give you the updates. So the idea is it's not the stuff you can just get from scouring the web, and it's the stuff used by people who are going to move the markets. And I like to think of myself as a great democratizer. There you go. First questions first. Is the market overvalued? Let's start off with the top-down view. This is the most important thing that we need to know mid-month, because we've got to put everything into context. Well, I'm going to read you what I've written there. First of all, global equities have returned around 11% the first quarter of this year. 11%, that's global equities. The all-share index was up 6.2%. That is a rip-roaring return. Whenever in the US, the S&P 500 has in the first 2 months of the year had back-to-back gains, as it has this year, and as it had in 24 of the last 66 years, the average gain during those 24 years when it has happened has been just short of 20%, with not a single down year. As I mentioned, this is one of those years. Is it going to break a 24-year running streak? Well, I'm putting my money on it isn't going to break that streak. The most positive region at the moment, in terms of Western economies, I should say, is the United Kingdom. That's got 56% of forecast changes in the last 4 weeks being upgrades. Stock forecast changes, upgrades in the last 4 weeks, 56% upgrades. Despite the market rally, equities trade at a little over 12 times 2002 earnings. Since 1982, whenever there's been bear markets in bonds, and there have been 7 of them, don't worry if you're not a bond specialist, but there have been 7 bear bond markets, each involving losses of up to 20% or 15 to 20% in US treasuries. Not one of these bear markets has caused a bear market in equities. 2 have coincided with flat equity markets, 84 and 94, and 5 have coincided with big equity gains. Guess what? We're in a bond bear market. That's the whole point of quantitative easing. It's supposed to make bonds unattractive, and so you take greater risk. It's finally happening as cash is moving more and more into equities. But you don't need to tell me to tell you that. You know we're at pre-crisis peaks in equities. So the issue becomes, well, what's the outlook then? Well, as I've already indicated, I don't think we're overvalued. However, we're not as undervalued as some people seem to think, and I'll explain why as we go through the webinar. The S&P 500 traded at 14.1 times earnings when the market hit its most recent high on March the 1st. That's the lowest valuation of any 52-week market high going back to 1989. Again, a lot of reasons for me to be bullish on equities. We're obviously going to have a look at individual equities this mid-month, and we've got concerns about Spain. We've had some news out even as I prepared this webinar. I'm going to go through today's news, for instance, and how that plays out for the rest of the month. But just to bring us back to those earnings figures, the S&P 500 PE ratio based on what's called the CAPE ratios, that becomes the cyclically adjusted PE ratio, which is basically an inflation-adjusted earnings figure over the last 10 years, or you might know it as the Shiller PE ratio. Supposed to be more accurate than most. Well, that shows us at around 22. So as you can see there, we're not quite as undervalued as you might think, and certainly looking back historically, the markets have, for instance, in the mid-60s, been quite happy to fall back from these levels, and I'd probably say we're at a midpoint between overvaluation and undervaluation. Some would even argue that given where we were in the 90s up to the dot-com boom, that yes, we could see a repeat of that, but that's probably unlikely, and that we're probably quite well valued. And at the moment, I'd say we're fairly well valued. I wouldn't say overvalued, it's just fairly well valued. So although I made the case previously about being undervalued, once you start looking at things like the Shiller PE ratio, Shiller's a professor at Yale University and very well regarded, you get a more realistic view. And this is the kind of information that I'm talking about. When you look at the FT, you'll see the regular PE. When you look at sources that I'm talking about, then you start getting data like this, which says, well, let's not get too over-exuberant. Let's then look at where we are. Now, you've seen that in the first couple of weeks of this month, the markets have actually held up fairly well, particularly last week. The first week of the month, it looked shaky because of concerns over Spain, but actually this past week, including today, they've held up quite strong. My predictions for this month were negative. I don't think I'll be wrong, because the month still has much to go. But overall, as I've mentioned before, I remain bullish for equities, and therefore any down moves in the market that I see this month, I'm more than happy to buy into weakness.